Sorry I missed yesterday. I got caught up in a situation where I just felt uncomfortable doing the podcast at that time, the spaces at that time. So thank you everybody for showing up today. And I was unsure of what your Saturday mornings are like compared to mine. Mine are always the same. I just have to walk the dogs, and everybody else sleeps in. So I have a couple of hours to have some fun on spaces. So. Bad month. November's ended. I don't think. Not sure if December started out yesterday not great for the trend followers. Although it's different all across the board, depending upon like last month, depending upon how many bonds you traded. Probably is going to depend upon how well that month went for you, and same as probably yesterday. So I've heard you hear numbers all over the board. I'm sure Chuck Norris, Paul Mulvaney did pretty well. He's on a very hot streak, so he probably is going to bail out the industry with. Too bad he doesn't have 2 billion or 20 billion compared to his few hundred million. But so yeah, that was kind of a tough go last month. I'm pretty sure for most CTAs. I've seen some numbers come in -4 or 5 for some big managers, so not too bad, of course. But yeah, it depends on how many bonds you have. The bond markets are, and a lot of CTAs trade the bonds, and I think they're mostly short. I ventured over into the fixed income ETF category earlier this year, and I'm long some quite a few fixed income ETFs, which act a lot different than the government bonds, or they have been recently. So that's helped me a bit. But yeah, and I think I was thinking about the year, and it's kind of flat probably for most people. It's like what's happened. Like not too much has happened in stocks. No sustained trends. Dollar's been pretty choppy. Rates, I guess, have not been huge outliers this year. But we have our great cocoa, coffee, sugar, cocoa, sugar, OJ trades, which for me are not going to do too much with my portfolio because they're pretty small trades. So I think maybe hopefully December turns into a great period, great month. December 1990, I made 30%. I don't think that's going to happen this year. I'm just guessing. My portfolio is set up a lot different than it is now. But we'll see. Not too late. Can hopefully eke out a little small profit for the year. I don't know if you guys saw this tweet or post from Moritz yesterday. I thought it was pretty interesting. It was an article from Bloomberg talking about how CTAs dominate the oil market, the crude oil, I guess. And they made all these claims about how CTAs are just this dominant force in the crude oil, and they're bigger than oil companies and the Koch brothers, which I always like to tweet those things because I think it's funny. And how great is it that that's even true? I mean, I know Moritz didn't like it. But I kind of liked it because I thought it was kind of funny that they write these articles like that, and especially if it's true. And I think we should. I like the idea that it's true, because it's good that CTAs are getting a lot of exposure and that they are big into the oil market. And the oil market's difficult to trade from a fundamental point of view. And if anybody's going to get it right, it's going to be the trend followers, obviously, in every market. So I think it's great. I think I like those articles that probably exaggerate the influence. And then there was another article I liked. I tweeted this one, I think, a bit of it. China commodities. And talking about how a lot of managers have withdrawn from China commodities, or China in general, And there's a China bond future coming out. I think we're going to be able to trade. It's going to be traded in Hong Kong. But they're pulling out of these China markets because of the lack of opportunity there. And of course, this is a fundamental idea, this opportunity, quote unquote. Whereas the CTAs, the algorithm, the client traders were rushing into China because just for the diversification purposes. And that's exactly the way trend following needs to look at all these markets, is that there are other opportunities right now. I mean, who the hell knows, right? But if you can find a set of markets that don't correlate with the markets you're already trading or are different than the markets you already trade, and I don't really care if it's not, if it's moderate amount of diversification, but that's our idea, is we're going to go into these markets and trade them and put them in the trade sheet, put them on the units, put them in our portfolio, because they offer some diversification irrespective of the immediate benefits that we sort of foresee, which we don't even try to foresee. All right, that's all I got, Oleg. What do you have this morning?
Hi to everyone. First of all, I want to say thank you to all of you who wished me happy birthday. It was really very happy for me. This warm greetings, warm words, warm wishes, and it was. I thought how meaningful it is. Really, it was very meaningful. So it's really, and I'll always say that I'm very happy to be here. It's a tradition for me to say these words, and I get remember that how 2 years ago, how in 2021 I missed a plane because of our weekly meeting, and never regret of this. And twice I missed a dentist. Last week I missed a dentist. Yes. And I have forgotten that I have a pain in my mouth. I was so happy that I forgotten. And I remember that 2 years ago I was a little sick with coronavirus in St. Petersburg, and I have forgotten that I have this coronavirus. So it's really very, very meaningful, very, very important. And all these, our ideas, our philosophy. I remember that for many years, maybe I was alone in this journey because I started to trade in 2007. In 2009, I began to do it in a more systematic way, in a trend following way, but I didn't know a lot of things then, and get this unique knowledge because of Jerry, because of Maritz, because of Nils, because of this podcast that I have discovered in 2019. Yes, I had a lot of my own research, and so I came from I followed in love and trend following for the maybe first days I saw in 2008. I saw trend following systems, trend following models. I began to do research on this. And this love is stronger and stronger for the trend following, like Jerry also says something similar. So this week I was listening podcast with Jerry that he published, retweeted on his Twitter, and I like the words about total story, and he said that such thing that Jerry said, we learned, but we were in an incredible environment. Amazing mentors and teachers, this incredible smart people plus the environment that we were encouraged to do the right thing. And if you are losing money, but you are doing the right thing, that's fine. In fact, if you are losing money, we may give you more money, but if you are making money and kind of not doing what you should be doing, you may get in a little bit of trouble. So it was just a perfect environment to start. And it's the opposite today, where a small drawdown will create all kinds of angst amongst clients, employees, and friends, and whoever. So that particular environment, it was just amazing. So very beautiful words, very important words of Jerry. Hi, Maurice, by the way. So Very important to have an environment, to have this mindset, to do the right thing, to do the right thing. It's in I think in all fields of in all walks of life. I know the most important thing maybe is to do the right thing and not to listen people who don't do this right thing because they want more comfort. So of course we must do love what we do, but we must love what it takes to be good at what we want to be good at. So do the right thing, do the hard thing, as Jerry said. So let's get started. I'm very happy to be here.
Thanks, Oleg. Outstanding. That is outstanding. I mean, I don't know. Your next stage, your step might have to be up to the host's seat here because you've done such a great job with your openings, especially because you're making me laugh a lot. That was really good. Really funny. All right. Richard, welcome back. How are you?
G'day, Jerry. Hi, Oleg. Great to be here. Hello, everyone. Look, hopefully my tech stands up this week. Last week was a bit appalling, so I couldn't really contribute. But yeah, Jerry, I saw Maritz's great tweet. G'day, Maritz. How are you? So the Bloomberg, sensationalism. This isn't the first time they've done it, of course. They seem to have it in for us poor old trend followers over here. But yeah, I'm so glad Maritz put that out. It puts things into perspective. And Jerry, yeah, China commodities. I always get excited when these new markets open up, and I just see this as opportunity. The good thing is that we're applying a rules-based process that we know works well on any liquid market. So when these new markets open up, that's just opportunity heaven for us with more diversification potential. Obviously, government regulations and, some of the counterparty risk and all of those issues need to be dealt with. But when these new markets open up, it's just a significant opportunity for us. So, I don't understand why people are bailing from the Chinese market. I certainly think CTAs would be actively looking at increasing their diversification within it. Look, we managed to put out the latest episode of the Algo Advantage with the barbecue we had. Jerry, fantastic time. Loved you down there. Hope everyone has had a chance to listen to it. It was a real buzz, great environment, and it was a great discussion, and I just loved every moment of it. But glad to be here, and let's see what happens on this episode.
By all means, by all means. I wanted to throw in one thing. I see Seth is with us, and Seth is one of our reliable trend followers who likes to concern himself with crypto. I just wanted to say that I have just created this crypto blockchain sector in my portfolio. So I have like 22 stocks and two companies that are involved in crypto and blockchain. And then I continue to trade the futures for Ethereum and Bitcoin. So I have carved out a new sector: currencies, commodities, stocks, bonds, crypto, trend following. And, there's a bit of diversification there. They all rallied yesterday, of course, I think. But the charts look different. The trend following overlay gives another level of diversification. And golly, compared to whenever I think about, is this going to add to diversification? Which, number one, I really don't care about too much, right? We're hunting outliers. We've talked incessantly about the periods of time where markets that are 90% correlated with each other, one of them takes off and a big, huge outlier, and the other ones don't. So we have this mixed relationship with diversification and correlation where we like the diversification, but we kind of try to ignore to some degree that some of the markets are highly correlated. And then whenever I think about like this crypto idea, am I going to carve out a section in my portfolio and call it the crypto sector? You got to compare it to your bond sector. Now, look, for me, I get an A+ because I trade, 10 or 15 fixed income ETFs, and a lot of those are in uptrends and have been in uptrends compared to my 100% short almost for the past 2 years, 2 or 3 years, government bond futures. So when you compare it to the bonds or even the currency sometimes, the dollar is kind of weak now. Maybe I'm making money over the past month in a couple of those currencies, but the other 30 I'm losing money in. So it's really not a high bar to say, okay, I'll throw in this crypto sector where, they kind of look similar, but not exact. And then, we always have the trade volume overlay to bail us out a bit on the correlation issues. And I tend to focus, I would say like almost 100% on thinking that I'm going to get some diversification in the P&Ls, not the daily correlation, the daily price movement, but the P&L. I'll make 50 ATRs on one crypto or 20 on the other, 5 on the other, but they were all 90% correlated. So that's kind of the way I've been doing it. And then spreading that out over now 350 markets minimizes some of those unfortunate days when all the stocks go against you or bonds go against you or crypto goes against you. So anyways, who wants to talk next? Go ahead, Oleg.
I wanted only to say that I thought a lot, maybe a year or two ago, that crypto is very uncorrelated thing because it's not a currency. In fact, there is. I like crypto because there is no. I remember that Nils said that there is no fundamentals behind the crypto. No. So only trend following here, even for people who believe in fundamental factors for global macro, but crypto, there is no such thing for crypto. And I'm not even talking about this topic now. I want to say that, yes, crypto is uncorrelated too, and I think it deserves to be a sector. And I was thinking about this a lot really a year ago. I want to say only this.
Morning, Alp. How are you?
Hey, Jerry. Hey, everyone else. Can you hear me well?
Yes, very well.
Cool, excellent. I mean, look, I am not going to make you jealous, Jerry, but November was a positive month, all right? Now the way, of course, I trade is, the short-term trading, all right, is the ability to catch bottom and tops in the markets. And so this means that there are months that we are going to be correlated. So we will be making money at the same month, but there will be many months where will be the performance will be separated. And I think November was a prime example of it, because when people saying on the Twitter that the hunting bottoms are not profitable, and actually I was thinking, this can't be right. Hunting bottoms and tops are actually what you do with the short-term way of trading. And so a lot of positions opened on my strategy in the 1st of November, immediately with the Fed started to speak that week, and then the CPI reading came below expectations. So in a week or two, I started to go long the bonds very quickly. So they were making money. And then towards the end of the month, some commodities made money. And then some equities, as joined to the club. And so, it wasn't a very positive month. It's, like 4% or something I've done. But it was a positive month nonetheless. And so that's positive. And in terms of this month, I think this month is I've never seen such strong start to a month in my trading experience in the last 2 years. So everything else is trending at the moment. What is not trending? Because I'm already short the dollar across the board, so that is trending for me. So I've shorted the dollar like from an index of 105 or something, and then of course the gold is trending, the silver is trending. I'm sure the long-term traders are already in gold because gold is making all-time highs, right? So you must be in the gold trade in some shape or form.
My futures chart is not making all-time highs. No, I think you underestimate how slow I am to turn things around. But look, I don't get jealous.
I'm
happy
flat
for
in
you.
gold as
Please
well,
keep going.
Jerry.
Yes, I'm joking, of course, but it is, yes, and thanks a lot for that, Jerry. So apart from that, yeah, I would say, the Russell 2000 started to work, so that's a big thing. Russell 2000 last month was hanging around 1700s. Now I think it's going up like last 2 to 3 weeks. And I think that's the main thing for my portfolio this month and going forward, whether I will be able to, generate returns depending on this soft landing scenario is going to play out or not. So Russell 2000 has been very shy during the year, as as we all know, that the stock market, equity market returns came from particularly a handful of stocks. So I hope that will change, and if that changes, of course, that is going to be positive for anyone else who's trading single name stocks. And during the year, a lot of people who were actually trading indices have made good amount of money in 2023. So I wasn't trading indices, and that created a performance gap. But now, if single name stocks are going to do good, then that performance gap is going to be closed because the Nasdaq, the S&P will not be able to generate those high returns, whereas there will be outliers coming from single name equities, which is I say which is going to be pretty important. So yeah, I mean is and next year is going to be an interesting one. I mean this year, it's just passed like this. Mainly my returns came from as you've been all telling, mainly from outliers rather than any major sector moves. And when the money has been made by outliers rather than sector moves, you can only go so much. So that's the main thing. And so I'm looking forward to catching an established market type. I'm hoping that the equities are going to stay in the bull markets and not going to go down like they've done in the middle of July this year. So I hope that will create a sustained trend, and that will make a lot of difference. And other than this, when I'm thinking about yes, crypto. So the way I trade crypto is what I'm doing is, so I've divided my forex risk into the dollar, yen, and crypto. So that's how I am doing it. So that's so the crypto segment is more or less have this equal weight as the dollar portfolio, and I do have few crypto segments there, so that's positive. But yeah, I mean crypto. I mean this year crypto is the major winner. If you would be trading crypto since the beginning of the year, I would say many people would have been gone from flat to somewhat positive, because the wins have been quite dominant, like in January and in June particular, and of course since the middle of October, Bitcoin rallied as well. So there are 3 months out of 12 that crypto has generated those outlier trades. Like in the middle of the year, there was a time where Bitcoin Cash has moved like significant, so crypto is definitely, with the small risk approach, why not? And I know that there are risks around trading crypto, so it's not for everyone else. So yeah, it's definitely there are downsides of trading crypto, but as a trend following trader, especially a diversified one, when you're assigning 20 basis points risk or even less, I don't think there's a lot of things that you can actually be afraid of. But yeah, I will be curious about this month, how the December is going to end, and whether the small caps will continue this rally or not. Thanks a lot, guys. Cheers.
Hi, Moritz. What's going on?
Hey guys, just had some tech issues with that Spaces. I couldn't hear you, and then I could hear you again, but I hope it works now. What's going on is a lot of snow here. We got 3 to 4 feet of snow overnight. The roads are blocked. I'm not sure if anybody else is in Germany, but this part of Bavaria, we're kind of like locked in. And only a couple of days ago, I was hanging out with you in sunny Sydney, or 36 degrees centigrade in Perth. It's quite a change. So I guess it's about time to get the skis out of the basement and do stuff with the kids. It's all good. Just listen to some of your performance numbers. I didn't have a very good start into December. Yesterday night I got this email from Andrew Strassman, 40 in, 20 out. I think he was up 2 point something percent on yesterday, on the Friday. I'm about down about that amount for yesterday. It's still the bonds and the currencies. I mean, in terms of the speed and how slow these systems are, I had a look, and in most of the fixed income markets, I'm still about 6, 7, 8, maybe close to 9 initial ATRs away from my exit. So I'm not even that close to be getting stopped out, which means there could be more give back, more pain, but. Look, this is not the first rodeo we're doing with big profits becoming smaller profits. These bond trades, at the end of the day, when all is said and done, these short bond trades will be good trades. At that point, the question is just how good are they going to be? Are they going to be absolutely magnificent and outstanding? And maybe the things will turn around again next week and yields will rise again. Who knows? Or are we going to be stopped out in a couple of days or weeks and then try our luck somewhere else? So who knows? But November wasn't therefore all too great. Currencies, the bonds, that's where most of the losses happened, and some of the markets which used to provide real good positive P&L, OJ, cocoa. Well, cocoa has actually gone up, I think, in November, but some of the other markets lost a little bit of steam. Anyway, so just 1 month out of so many. Let's see what December brings and the new year. But yeah, all is good. Happy to be back after a lot of travel. Getting back into the workout routine, sitting in front of the computer, doing some work, catching up on stuff. Kind of like Christmas time here. Going to a Christmas market later on this afternoon. I don't know, pretty easy, pretty good life.
As it should be for a trend follower. Everything about life is great because we're not really working. We're having way too much fun. I sort of, I'm still able to stay long. Just looking at some of my currency positions, I'm still long, like the pound, a little bit of pound. I have 4 systems, so I'm still long a bit. That's a good thing about these long-term systems. When you get this kind of, well, we were long, then we got short the currencies. Now we're getting run out of the shorts. So don't get so happy when, like, okay, now we're all short the currencies. Wow. Okay. Now let's see what's going to happen. Well, nothing's going to happen. They're going to rally, and we're going to have to get longer again. The dollar's going down. And the same thing could happen to the interest rates. This trade's not over. It doesn't mean I don't care what Ackman says. I kind of don't want it to be over because I don't like when predictors are right, because it doesn't matter to me. I mean, maybe I don't follow the news that closely, but it's kind of like I don't like when individual people or prove correct with their fundamental, like, this is the bottom, let's get long. And I don't, and another thing, it seems to me, although I don't follow the news that closely, and I don't know how to interpret the news. I was telling myself yesterday, I don't know if I understand the English language that well, because it sounded to me like everything that comes out of the Fed is always bearish, negative. Don't get ahead of yourself. We could still raise rates. And the only thing that happens is it doesn't matter what is said, as long as when it's said, the market's going to rally. It rallies every single time. And so I think to some degree, that's bullish. You've got kind of, in my opinion, somewhat negative news for rates, caution, and yet the market is sort of saying no. However, we're going to be better off sticking to our systems, and the best systems are still short. The best systems based upon the back test. Well, from a long-term trend following point of view, Alp has his systems, which are daily bars, trend following the hourly bars, which I really like. Hourly bars, I really like it. No one likes it more than me except Alp. But yeah, Alp's going to do better. We're all going to do better just by sticking to our systems and not trying to worry about, is this the lows? And there's nothing you can do, because even if you try to front run the system, like you could just be proven wrong. Like Moritz said, these things could go back down to the lows and then rally again. You just don't even know. The great thing I like about my longer term strategies is that I tend to suffer less whipsaw pain, but then the downside is I tend to get back more in profits, and looks stupid. I'm selling at the very low, buying at the very high, and oh well, it's 30, 40 currency markets out of 350, and I trade a lot. I mean, I trade even more of the cross rates, what I call cross rates: Aussie yen, Aussie Canada, China yen, Euro Swiss, Euro sterling, things like that. So these crosses have different trends as well. And I guess when you live in a different country outside of the US, you look at the yen through the terms of the euro or the sterling. And so this is just another way of.
But I just want to say something about the metals. I'm not even long gold and silver at the moment. I'm just out of them. I got kicked out of the gold position, I don't know, 3, 4, 5 weeks, something like that ago. And I don't have one yet. So the only thing I've got is short palladium and short platinum. So I've got that one mixed up too. Damn it.
Yeah, the gold, I looked at the cash gold chart. It is at all-time highs. And our gold, the futures, is not quite there. It's below, but I guess we'll have to I got short gold and silver, so I'm out of those. But I'm going to just pay attention to the futures chart, which is can always be a bit different. Yep.
Yeah, that's right. I had the short gold, short silver, and then got kicked out of the short gold a couple of weeks ago. But yeah, if it makes a new all-time high, then for sure we'll be long.
Well, Jerry, I've got rocked my world this morning. Excuse me, Rich Brennan. I read his collection of tweets. What do we call them now? Tweets. Hey, Elon, go F yourself. We're calling it Twitter, okay? So I'm reading Rich's set of X tweets about overfitting. And of course, Rich usually is brilliant, and here he's outdone himself. He has outdone himself, Jerry. And then I had this great thought, which I posted, which says, if you're gonna want to, predict the future, it's a bit miscalculating to consult the past. Instead, it's probably a better idea to try to consult the future. And that's what's rocked my world this morning. Thanks.
You
Yes,
made
I
me
agree.
laugh, Josh. I love that.
I agree. The only person that can outdo Richard is Richard himself. So he does that too, which is good, because sometimes we're waiting and waiting for Richard to outdo himself again, and it takes a while, but he ends up doing it. I was wondering if you wanted to summarize. You had a long set of tweets this week about warehousing risk. Rich, did you want to summarize that for us?
Now, look, what had actually prompted it, Jerry, was all of these comments about Mulvaney. And, when what always grabs me is when I put something up about Mulvaney, I get a horde of people coming in and saying, oh, yeah, but, if we leverage up this Man AHL solution, or if we do this, it significantly outperforms. And like, to me, that's a red flag to a bull, because Mulvaney is the one who's actually delivering these absolute returns. These other fund managers, they might have smooth returns, but they're not delivering that same level of absolute returns. So then the excuse comes in, risk-adjusted returns is what we should look at. And this is exactly the problem we meet in backtesting world, because in the backtesting world, of course, we effectively, whenever anyone does a backtest and they're selecting from a backtest, and particularly when they're selecting the best performers out of a backtest, they're optimizing to the history. And it's always far easier when you've got the history laid out in front of you. This is from a position of hindsight. Of course, you can plot the best route. That's natural. And it's exactly the same as in the fund manager space when we're evaluating fund managers. When you've got the track record in front of you, the validated track record of all the fund managers, of course, then you can sort of put together blends and leverage versions that outperform each other. But the bottom line is you never have that principle when you're going forward into an uncertain future. You never have that roadmap. And this is a significant difference between realistic expectations and backtest or treatment of validated track records, all of these things. That's from a position of hindsight. And really, we've got to shake that entire notion from our head, because we don't have a roadmap laid out in front of us when we're going into the future. So the question is, for the fund managers, Mulvaney actually chose to leverage his fund at a particular level. He has achieved the best absolute returns. Full stop. I don't care about risk-adjusted returns. He has outclassed all of the other fund managers over the last 20 years in the particular series of funds that I'm evaluating. That's where you give a big hand clap, because that's from the perspective of someone who doesn't have that roadmap in front of them. And that's the most ballsy position. That's the Chuck Norris in him, and he's got to be commended for it. So I'm just getting a bit fed up with all of these people that come in and say, oh, yeah, but look how volatile he is and all of this thing. The bottom line is he's achieved it. He deserves the commendation.
Hi.
Yeah, I agree.
Sorry.
I just want to comment on that. I agree. I do think that we should measure returns risk adjusted. I know my pinned tweet gives the impression that I don't agree with that, but I think what the pinned tweet, which is not my quote, it's that other guy from Taleb's firm, Spitznagel. The problem with risk-adjusted returns is that they use it. The industry, the whole world, outside of the trend followers, use the wrong measurements for risk-adjusted. The risk piece, risk for trend following, the part that goes into the formula, considering risk, should not include volatility of the open trade profits. And in my opinion, I'm going off the rails here, which I just love to do. It should not include open trade equity drawdown either. So but obviously if you have two systems then that are exactly the same, Mulvaney 1 and Mulvaney 2, and all they do is one trade's larger than the other, that's good information. That's the most simple, fundamental step one kindergarten way of acknowledging that, hey, one's more risky than the other. You're not gaining anything by netting out anything other than more profit and more risk, more volatility, more drawdown, and more risk by trading twice as large. I like your point, though, that the ultimate idea is that he survived. And that is sort of what the accurate risk measure should be all about. Does this risk measurement, whatever it might be, does it translate into our ability to survive? In other words, does it measure properly the future ability to survive? Because people who trade very large and with lots of extra risk, they might not survive, and then yet they might actually survive. And so they may go to their grave with a great track record and no one ever really knowing that it was, if they'd have lived a bit longer, it would have not have ended so well.
If we had a guarantee, Jerry, if we had a guarantee that smoothness or, these risk-adjusted returns were a measure of survivability or robustness, yeah, I'd have no problem with that. But time and time again, we've seen these track records of incredible smoothness that have absolutely blown up because the metrics used to assess that smoothness have not looked at the warehouse risk embedded in that strategy. LTCM, you name it, there's a whole bundle of them. So even if I do see something like Man AHL, or a good example was Fort and their global diversified program, and Fort in their other programs had this wicked negative skew after 20 years of smoothness. So when talking about risk-adjusted returns, trend followers are saying, hey, risk is not volatility. And then again, we're then embracing a principle of risk-adjusted returns. I'm really struggling to accept this principle of risk-adjusted returns.
I'm struggling to accept it in the way that it's created. Traditionally, obviously with Sharpe, we need to find a better risk metric when we do our own back test. It's got to be more. This is what's so silly. It's the information is there, so we're going to use it. I mean, that's the idea. What if the information is incorrect? I don't know. But that's the only information I have is the monthly performance table, and that's what I'm going to use. And that's just a silly way of approaching it scientifically. And so when we do our own back test, it's okay to complain about Sharpe and open trade equity drawdown, but you've got to come up with something. And just because we're looking much deeper, we can look much deeper than just looking at the back test. I mean, just looking at the performance table. We've got of a manager a monthly performance table, which we have no idea what really is going on, and that's what happens a lot. The traditional risk measurements fail, especially Sharpe. But I do think you bring up another good point, which is if you have your act together, you've got a great system, a great trend following system, and you have a better risk management metric of measurement of risk, and to the outside, it looks very volatile and very crazy, parentheses, Mulvaney, but you end up with a very, very long-term track record. And you survived multiple decades, then I think that's a little bit of evidence for that you should get the benefit of doing a good job of measuring risk. And it's perfectly reasonable to say that if you undertrade because you miscalculated the risk, i.e. you use Sharpe, for instance, then that should be a negative to you. And not only should Mulvaney or someone like him, the straw man Mulvaney, the perfect trader with the perfect trend following system with lots of leverage, but he has a strategy that survives as well. He needs to get credit for the accurate understanding of risk to where he traded his ass off and still survived. And if you undertrade because you have an inaccurate measurement of risk, you should be punished for that. I mean, thought less of. That's another edge for Mulvaney. He has his great systems, he has his great markets, he has his high leverage, and he's measured risk correctly, which ultimately all of these measurements need to flow down to the bottom line, which is it is an accurate measurement of my ability to survive and create a multi-decade track record, which is pretty much what Rich has said forever, is that the best evidence of a good trading system and a good strategy is a verified, long-term verified track record.
Exactly, Jerry. And look, there's another factor to consider about Mulvaney, And that is, if people looked at that chart I presented, where I compared Mulvaney to 9 of the other best performing CTAs in trend following world over the last 20 years, what you'll find is everyone's saying, oh, Mulvaney's performance is just the last 3 years. It's actually not. When you look at the entire 20-year track record, you'll see that Mulvaney is consistently floating to the top of the group over the entire 20 years. So this is saying that he's got some form of robustness in his process. He's able to deliver absolute returns. It's not just the last 3 years. You can see it in the entire track record. And some idiot was saying the other day that, oh, there was a sequence of years where he underperformed the SG trend. Well, look, I did the comparison and I found that in no way did he underperform the SG trend over the entire 20-year period. He absolutely floored SG trends. So, people seem to create this narrative out of, what they believe, but it's important to look at the data.
Go ahead, Kadura.
Hi, guys. How are you? I was wondering, Richard, thinking not about risk-adjusted returns, but what about inflation-adjusted returns? Would you take that into consideration? I was thinking, and I asked you in the morning. Thanks very much about interest rates, and now they are rising, and you have all these, in standard CTAs, you have all this money to apply in treasury bonds, etc. So since inflation adjusted returns are the same for every manager, meaning that they don't depend on how they deploy futures, how they deploy their strategy. If you take into account inflation adjusted returns or spread over treasuries or spread over inflation when considering performance. I know that the trend following is one of the best, if not the best, strategy against inflation itself. But anyway, if you consider that one, the inflation adjusted returns as a good measure of returns, or nominal returns are good enough. Thanks.
Yeah, when I think of the word absolute returns, I'm thinking in real terms. I'm not thinking in nominal terms. So yes, inflation adjusted returns is an important principle. And if you're dealing with delivering absolute returns to your clients, yes, you need to take the real rate of return into account. It's not presented that way by industry, but yeah, no, I'm totally on board with you there. I don't think we can have this notion of absolute returns if we don't take into account inflation adjusted returns.
Yeah, thanks. Because now when interest rates come to 5%, etc., there is like a source of comparison, so to speak, that it's in a much higher standard than when you're just using nominal returns to compare each other. But as you said, all the industry, they only compare nominal returns.
Yeah, somehow this 5% T-bill rate, which maybe it's a little bit lower today, but it needs to be figured into, this idea that CTAs get this free 5%, and the 5% added to their performance table. So it's you should absolutely invest in CTAs because it's a free 5%. However, inflation is highly correlated. Rates are highly correlated to the inflation. So it's 5% now because inflation was up there 5% or whatever. And contango is now reflective of being able to put up 10% and earn 90% at 5% of your margin. So that is increasing the contango, which CTAs ignore over and over. Over and over, they ignore it. That contango is now higher because rates are higher. But no. It's free. There's nothing to see here. That 5% is free. It gives you a +5 on Jan 1 with your CTA investments. How can you possibly lose?
Yeah, I think it's a hard, it's a hard discussion because everybody fits one variable fixed, like you said. For example, if you see a simple moving average strategy, and you say, well, if I'm in, I will earn the trend. But if I'm out now, I'm earning 5%. So ceteris paribus, as they say, I'm winning more. But as you say, you cannot fix the trend variable because the contango will do something. Will decrease your return if the spot trend is the same. But you know, it's sometimes it's a little confusing when you speak about trends if you're speaking about the trends in the future market or in the spot market, as you said earlier about gold, that you look at the gold spot chart.
All right, buying gold futures now is $18 more expensive. But that is not a subject we're going to talk about because we're going to just talk about that free 5%.
Yeah, you're right. I think many people mistake that they think that it's free money, but when you speak about real returns, that conversation gets a little more clear, right? Because as you said, that interest rate, that contango, it has a lot to do with inflation. So when you speak about real returns, that makes things much more clear. Many people think that trading in futures is like a two-layer strategy where you're earning what you already earn on the spot market plus that 5%, and that's not correct.
And so the counter to that is that, well, something that they could throw out there, which I have to help them. I'm going to help them throw something else out there. Okay, so which would be that, well, Jer, okay, gotcha. Now, however, half the trades we do are shorts. So we've got the contango that's helping us now because we're shorting a higher price now. If I go short gold, I've got $18 locked in. Was it 18? Yeah, $18 locked in. And then my comeback to that is, which this is above my pay grade. So I wish they could just take this argument over and acknowledge what the truth is and then expand my level of knowledge. But is that when we've done our back tests, because I have a great back testing team that's been around my guy's been around with me for 30, I don't know, over 30 years, 35 years. And so we've never seen in larger contangos even help make the short trades profitable. That's a pretty sad story for trading futures that short commodities don't seem to miraculously turn profitable or more profitable or become better trades, materially better by having this wind in our sails when you short at the high contango. So no, that's looking at all the data, not maybe it is over those periods. I don't really know, but that is, it is a reasonable comeback. But they're not even involved in the real debate, so they don't come up with any of the nuances.
Not even in the financial futures, right? When the contango, the backwardation is mainly a consequence of interest rate.
Right. We can never see too much benefit in shorts didn't seem to be very good in any strategy in any sector, currencies, commodities, stocks, bonds, certainly crypto. Yeah, we didn't see much there to help us in those shorts. Now, I remember years ago of doing a lot of research on correlations and seeing that, and I don't know if this has held up over time, but I remember noticing that something that Rich told me in 1983 is that the longs are all correlated and the shorts are correlated. So if you're long all the sectors, that's more risk than being long currencies and bonds and short stocks or something like that, short in commodities. So longs and shorts, if you have a more balanced portfolio, regardless of the markets or the sectors, that's reducing your risk. And we definitely saw that. We messed around with that. And you could definitely see anytime you had a different position on long versus short, the risk would be reduced. But we had to turn the interest rates around. So it was more like, don't talk about being short bonds or long bonds, but long rates or short rates. So when you flipped the bond markets around, that was the same as well. That long rates were correlated with all the other long sectors. I don't know if anybody has done that analysis, but that's what I remember being the case. It was, you had to switch the bonds in the other direction. There's another, since we hit a little lull here. I tweeted my thoughts or what I thought was interesting from Niels's Top Traders Unplugged podcast with Alan. And Alan was particularly interested in wanting to make a point about, this paper that CFM put out, and saying that when they analyzed CTAs, that the trend following part of managed futures plus other types of strategies, short term, mean reversion, pattern recognition, carry trade, all of those extra things that they add to trend following were added no value. They're basically trend followers may trade things other than trend following, the managed futures CTAs, but they don't really. All the other stuff doesn't really add much value. Only thing CTAs are really delivering is more trend, and of course they could possibly agree with that in the sense that these other strategies could be worth adding to trend following if it smooths out the trend following performance. And so, So Alan's point was that CFM trades a lot of other strategies other than trend following. Now, I don't remember if he and Niels talked about whether CFM measured their own contribution by these other systems. I don't think they did. Just the fact that, well, why is CFM talking about this? Because they do it themselves. So obviously, I guess CFM likes their added strategies more than they like when they valued the added strategies for the SocGen trend index. But so Alan thought that this paper was being misused, and I'm probably the most guilty person of misusing it because it was definitely my pinned tweet for a long time. But look, I can't help it. I'm just taking quotes from CFM in the paper, and so CFM says, and I went back and I read the paper, CFM's paper, and I even liked it more. Here's one of the quotes. Of course, individual CTAs can outperform the index by doing non-trend following strategies, but when summing up these contributions, quote unquote, gives returns equivalent to trend following plus noise, or extra risk, and ultimately lower Sharpe ratio. Trend following plus noise. That was my new phrase. I thought that was pretty funny. In an Allen, so I do go into these podcasts and pull out the perfect tweet, the perfect quote based upon what suits me. And I leave out what doesn't suit me. So Alan stumbled here. And he says, they're not saying that trend following strategies don't work. They just seem to be saying in the paper that CTAs are not particularly good at doing it. And I think that's pretty funny. So, I think that allocators spend their entire life trying to find these trend following plus something managers, and they hire them, and they create products and funds for them. So they're going to defend them. It's just not going to give up on this. It's going to be an eternal market for trend following plus lots of other things. We're in the minority. I'm in the minority as relates to trend following plus nothing. And then Absolute, I don't think he's here, made the point, wanted to make this point, shut me down, which was that, hey, Jerry, they're comparing, their trend following that they're comparing is trend following plus vol management and correlation management. which is which is compared to this noise, that this extra stuff that they classify as noise. But so it's not your classic trend following that they're comparing. Of course, because there's nobody who does classic trend following in the SocGen CTA index. They're not allowed in, and so that's true. But I don't know if it's if Absolute is trying to make the point that it's possible that classic trend following CTA who traded other types of shorter term mean reversion carry trade strategies, that you wouldn't come up with the exact same results, which I'm pretty sure you would. So I'm not sure the point he was trying to make there. But I think it's fun that these, that we're going to be hammered on about no one's going to ever give up on trend following plus a lot of other things. It just makes the ability to charge the 2 and 20 or the incentive fee makes it a lot easier to do that. And defending the incentive fees is definitely worth doing.
I agree, Jerry. I know many people haven't done this, but if you put, let's say you're successful in defining, say, 4 to 5 classic trend followers. When you put together as an equal weighted blend, you see magic happen, because each of them do have whole signatures. But when you put them together, they've got massive lifting power as well as suppression of volatility as a blend. No one's really done this. I have, looking at it, and that's where this CFM paper came out saying trend is the dominant contributor. That's what's giving the lifting power. These other techniques are really just methods to smooth out the volatility, and it comes at a cost. It comes at a cost of suppressing that upside volatility. And but when you put these classic trend followers together, magic happens. And I think that's probably an area I'm going to start focusing a bit more on in some of my my analysis in putting, the likes of Takahi, yourself, etc., into these blends, just to see the magic that's performed when you put it together.
So I have a long monologue on that particular subject. I'll try to shorten it up, and I want to get your. I don't even know if I can explain it, but yeah, I was thinking about this whole idea, and I think that like rather than doing that, finding a group of good managers, CTAs, trend, classic only, or whatever, right? Or even the perfect portfolio, which possibly, let's say, could include things that are not classic trend following. Okay, rather than trying to find all those managers, from our point of view, which is heavily based on backtesting and computers and systematic and things that we kind of like won't accept. Like I don't want to accept anything that's not systematic and backtested, and maybe some other things too, like stop losses, lots of diversification. So there could be like the 10 commandments or the 10 requirements of not just trend following, but like all of my portfolio. However, let's say maybe I would say I'll do a small percent of S&P long all the time. Okay, maybe you could say that, but that needs to go through a rigorous scientific process, right? Which is what I'm trying to describe here. So why don't all of the smart people get together and say, instead of adding my fund, why don't we just get together and say, let's come up with this ultimate trading rules. You've got some, I've got some, they've got some, and so then we have to kick some of them out. We say, no, this committee is like, no, you can't have your rules because my rules are better. You're missing something here. And so you get this ultimate combination of thoughts from a lot of different smart people who agree with the basics of how to build a systematic trading approach. And then, because look, you add me into your portfolio, And the reason that I'm added, for instance, is because I'm a bit different. And so you're like, okay, that is good. We're going to add Jerry in because he makes the whole portfolio a bit better. However, if you dug deep into my approach, I have made it better. Maybe there's not that much sample size of when I actually added value, but I did add value at some critical times. Maybe I will never add that value again because if you dug deep into my strategy and my rules, they're bad. They have a bad element. So the reason that I added value is because no one else is doing something wrong like I'm doing. So there is this period where my crappy idea, which over the long term is going to not do as well as other rules, whether it be make less money or create a little bit of risk, extra risk, which is somewhat hidden inside this portfolio of managers, that needs to be pulled out. So just accepting what I do because I add value may not be enough analysis to see if I really should be in the portfolio, and I'm only in because I'm doing some goofy things. Like let's say there was another article I tweeted, which was Corey Hofstein saying there's new evidence, there's new research out that says there's no such thing as the stock premium. You know, there is no such thing. If you look at more data, stocks, you should not rely upon stocks going up, the risk premium of stocks. So let's just say, though, that part of my portfolio includes long stocks, which have worked for a long time. And but maybe in the future, there'll be a total fail. You know, a group of people going into that and say, we cannot have long stocks, regardless that they've done well over the past 50 years. Why? Because it violates our rules. Oh, interesting. Yeah, we can't have long only. We can't rely upon something that doesn't have a large sample size of entry, exit, uh, sample size, not just, hey, this has worked long only for 50 years. So I think the ultimate project should be this Manhattan project for a systematic trend that yields the best systems historically and the best ideas for the future. That's going to uncover issues we each have with our own system. I know this is never going to occur. We're never going to do this, but I'm just saying that's the ultimate trader. The ultimate greatest trader of all time is a computer that has these perfect rules in there, and that these rules get more and more perfect all the time. What do you think?
That is so spot on, Jerry. I'll be your Oppenheimer. I'll be your Oppenheimer because the way we should treat a portfolio is no different to the way we treat our own personal portfolio. So as traders, we know what's built into the logic of our trading strategy. We know where the weaknesses lie. And the problem with conventional portfolio management is they're just using correlation measures through history as a basis to compile portfolios where the weakness still resides in those individual selections, and they're just using correlations as a basis to produce, the optimal mix. And that's where the fault lies. They should be doing it in exactly the same way that a trader develops their own portfolio. They should know exactly what's under the hood of all of those contributors in that portfolio. The problem is, of course, that the portfolio managers are probably not going to release what's under the hood. But that is the holy grail as far as I'm concerned. And understanding where the risk weakness lies in all of those contributors in the portfolio when you're putting them together as an allocator, it should be no different to how you develop your own trading strategies, using logic first, identifying where the weaknesses are, robustness tests to remove those weaknesses, only selecting the best optimal non-overfit solution for the future. We should be applying that in the portfolio world in allocation, as opposed to these very loose measures where, it's simply based on correlation measures.
But you can't know that information because they're not going to tell you. So you can't dig deep enough into what people are doing because all they're going to show you is their historical track record and say, look how well I've done. And then they're going to say, oh, okay, yeah, given all of this information, I mean, I'm going to interview and talk to you. I mean, is that going to be a plus or a minus? You know, a lot of good managers get rejected. A lot of good track records get accepted. So the ultimate in building these portfolios is to build your own and bring in, accept diversification, accept risk control. Probably you have to accept trend the way we do it, and then build this thing out so you know exactly what is in your portfolio and accept a rules-based approach versus trying to put everything together with just interviewing managers and looking at track records is not going to be nearly as safe and as good as putting it together yourself with your own systematic approach. You won't know what's in there without doing it yourself.
Or get a group of portfolio managers together to do the Manhattan Project, so everyone in that team knows exactly what's under the hood.
You're discussing about these concepts around, the right way of putting together the portfolio, but the customers have shifted, right? The clients have shifted. Clients have shifted their views of what is right and what is wrong. So, I'm feeling that, with clients shifting their approach, and what I am saying is, this is the right way of doing it. So I'm not using volatility management and correlation management, but our gap is also increasing. The gap is increasing. So there's a communication issue here. There's a marketing issue here. There's a sales issue here. So, but what is your view on that? How are you hoping that this right way of trading, which I believe actually quite fundamentally, but surely when I speak with people in London, and I've spoken with few people here in London, and everyone else talks about the sharp, the low drop, the usual stuff. So do you think that as the life moves on, are we going to be more disintegrated from their expectations, even though we will be generating higher returns? So I'm finding it. So what is the communication? How to solve this communication issue? What do you think about that? Thanks.
Well, I think you're talking about a slightly different subject now than what Richard and I were talking about. Okay, but so we were not talking about. At least I wasn't. I wasn't thinking about this communication that you're talking about. Let's. I'm not sure how to attack that, but well, I think the way to attack it, it's kind of like they were calling me out a few months ago on some podcast. Niels or somebody was saying, "No, wait a second, I forgot who it was now, but it was somebody was saying like, oh, it was Mike Harris, yeah, and he was sort of trying to give me the business for saying that. Okay, so he ran this research and he said, well, trading more markets and trend following, the only thing it does for you is gives you a higher Sharp. And then people who trade 300 markets, they don't care about Sharp. Ha ha, I got you. And so I was like, I can't really blame people who say things like that because I need to be clearer, right? But it's kind of like, no, I cannot care about Sharp and all of a sudden do things that increase my Sharp because it's not about whether I care about, it's about doing it the right way and measuring things the right way. So if I do things the right way, trade 300, 400 markets, if this inaccurate measurement tends to look better, this irrelevant, inaccurate measurement, Sharp, tends to look better, I mean, who's at fault? I mean, yeah, good for you. You're using the wrong measurement, but now mine tends to look better. So the way to get our measurements higher and to become more acceptable, we can still keep in our heart that we don't agree with all and sharp measurements as risk for the risk-adjusted return piece, it doesn't mean we can't do things that are not over-optimizing, not more rules, not reducing the robustness that will make those wrong measurements still look better. And that's where we need to go. We need to trade more markets. And then I also, maybe we'll get into this later, tweeted some of the quotes from, that one podcast that I really disliked from Floor and Court. 15 minutes spent on trading, which frequently wrong about that, and then 45 minutes spent on politics, which was incredibly offensive as well. And but I think getting back to what I was saying, which is the ultimate portfolio, leaving aside for the moment how to measure the return, the risk-adjusted returns, is this big Manhattan project of quant traders coming together and saying, instead of allocating to a bunch of managers to create a great portfolio based upon historical returns, which we really don't know what's going on inside of these portfolio. Of course we don't know, because if we knew, they wouldn't charge us. We wouldn't pay them 2 and 20. The way to ultimately know what's going on is to create your own massive computer program that puts together all the markets and strategies that comes up with this ultimate trading strategy that makes the best portfolio. And you just keep making it better and better. And part of that is adding more and more markets. And that's what the market has said, because that's exactly what the institutions, the most favored investors in the world, put their money when they're allowed to. That's right. You got to pay the high fees, the pass-through fees, and the big incentive fees to these multi-strat funds. And that's what they're saying is, I don't know what you're doing. I don't know what each one of these managers are doing, but you know the guy who runs the men and women who run these multi-strats, Griffin, Elliott, all these different people, Point 72. You know what's going on, and you know how to add these managers and then get rid of these managers quickly when they have a 1.5% drawdown, and find other managers. And there's an arms race for more and more traders to become part of these massive firms. And this is what people want. They want this type of an approach, and that's what they're getting. And so I was thinking, well, golly, it sounds like, maybe I've read over the years, that a lot of these people are discretionary. And so certainly a rules-based, back-tested strategy can beat those guys. But then I'm thinking, well, it's probably not that simple. Probably a lot of these people are systematic and quants, and they allocate to those type of traders too, not just the ones that are just discretionary macro guys who've been bouncing around from different firms. It's probably a combination of both, but I think that this is what the ultimate strategy would be trying to duplicate, is this 100% systematic approach that competes well with this multi-strat approach, which is a bunch of humans, maybe some quants as well. And another thing is, how systematic is it? It needs to be 100% systematic. I doubt these multi-strats are 100% systematic. And then getting rid of managers, and you're out the door if you lose 2%, and not looking at how these strategies impact the whole, that maybe you do want one of your managers, one of your traders, to be someone who's losing money now on the rally in the bonds, because that's a positive strategy. Nope. If you lose too much, you're out. You have to change your strategy. It cannot be optimal based upon the back test, because you'd have too big of a drawdown. All right. Does that make any sense?
I love it, Terry. Rather than finding good managers, finding great systems and seeing which systems prevail, and then having those be aggregated into an approach. It's almost like turtle maximization.
Right. The problem with the turtle program was there were turtles. They were unnecessary, right? They're certainly unnecessary now, because humans don't need to be a part of this process. Just the researcher, just the computer guy, just the math guy, just the guy sitting there to bless robustness to keep everybody in line. And so the next turtle class is just a bunch of computers or computer people and math people devising these systems, putting them all together, all these thousands of markets and different, my opinion would be something like different trend following time frames, and maybe some other types of strategies, hourly bar trend following, let's say. And so then you sit
I'm
back and you say,
convinced it can
okay,
be done, Jerry.
yeah. Then you sit back and you say, okay, we have the greatest minds available. It's all systematic. It's almost all trend following to one degree or the other, different time frames. It can't be beat. However, we are not approaching the smoothness of these multi-strat funds. They have this secret sauce that we cannot duplicate. And then you just say, okay, it's really darn close, and it's very consistent. That's another thing that I think I keep forgetting. It's certainly been my my experience personally, and my experience in the back testing is that that's what trend following really gives you. Long-term trend following gives you amazing consistency. And the same, you can have multi-years in a row where you make money and can be the best strategy as relates to making money consistently over a trailing 12-month period. However, it's going to have some bigger drawdowns. So, and I don't know. To me, it just seems a huge edge and opening, and it's incorrect. I mean, this is just me talking, but it seems incorrect that you have people or discretionary, or you have systems with edges, and then you don't allow them to fully exploit their edge, because all of a sudden you're going to come in one day and you're out or cut your risk. Why? Because other people are losing money. You're losing money. We're losing money, and we're not going to tolerate. And so it's just an opening, because you could say, well, we're not going to do that. We're going to have a systematic approach that the diversification allows us to have parts of the portfolio not doing well. Instead of firing people with a 5% drawdown, we'll fire them with a 15% drawdown, because we're sort of hiding that drawdown historically inside of the portfolio. And we prefer people to just do your system, and we don't want to cut you off in midstream. I would have been exited out of multi-strat in March of this year, because I let my open profit, I didn't get out of any of the interest rates when they rallied, right? And then a week later, they're all at new lows. Yeah, it's going to happen sometimes. That's why I do the strategy. The back test approves of this strategy, because that happens when you get the most bearish on your position. All hell's breaking loose in the rates or the currencies or whatever. They go the other way, and you're a hero. It happens. It doesn't happen probably that often, but it happens enough to where the computer says, this is how you should trade. And so you want that full blown manifestation of these rules to be able to do their thing, but they're not doing that. I think that is one of their weaknesses, and the systematic approach can exploit that, I think, versus this emotional approach of, oh crap, we're losing money, fire this guy, or cut risk.
But what about clients specifically, Jerry? The clients, because when you're talking, when Richard talking, Morris talking, I mean, it's very, the conversation is very technical. We sometimes talk about Dunn Capital. They are just another technical firm doing what they do, or other people on podcasts. These are all the the specialists, the experts, the traders, the money managers, and whatnot. But what about the clients? What about that? Because there will always be other people with other trading approaches, and I do not see them as the problem. It's not possible for other people to do something else, unless the demand changes. The people's perception of the clients' perception of what is right and wrong changes. So I think the root cause is there are these sort of people, the clients, and they demand certain thing. They do have a certain perception and certain beliefs about what is right and what is wrong, and unless it is possible to communicate with them and to explain to them, and to make the the marketing of the right way of trading, to be able to get to those absolute returns. And I think that's the crux of it. It's not otherwise. I don't see how the demand for the right way of trading is just going to emerge otherwise, without changing the demographics of the clients. Am I making any sense here?
Yeah. But I mean, I agree with all of that. And so I think the only way to do it is to do it the way that they did it, which is to show performance. So let's pursue this performance. Let's pursue this methodology. Let's pursue what the ultimate strategy is, and then let's win them by their performance. And then you sit down and you say, okay, here's the performance, here's how we do things. And they're just like, blah, blah, blah. I don't care. Look at that performance. Yeah, the performance comes first, and then you explain. But they love the performance. Not only do they love it, you know how the pass-through works. If you take a team building trip to Hawaii, you've just passed that cost through to the investors, and then you charge the 20 plus incentive fee. So that's what they're doing. People love these things. You have to be anointed to get the privilege to put your money in these funds. But it comes because of the performance and the stability, the consistency, and the smoothness. And all I'm saying is, to me, it sounds like because they have this fatal issue. But besides overcrowding and fees and probably lots of other things you read in the press, the thing that sticks out to me is, what kind of performance would any of us have if I randomly walked into your office and said, you're fired, or cut your wrist today, right now, you're losing too much money? I'm down 1.5%. Okay. It would really play havoc with your performance because you're not able to carry through with your system trades. And I think and they don't look at it as, hey, the whole portfolio is doing great. You got this one group over here who is underperforming, bonds are rallying, but they're the ones who crushed it last year. So it's really not even showing up in our overall performance. No, they're gone. We need a new team. We cannot have these individual drawdowns, even if they don't even matter. So I just think this is an opportunity for systematic people to say, hey, let's look at this. They're really showing us a roadmap here, and I think it's achievable and doable. And for managed futures CTAs, number one, they have to say, oh, well, let's trade stocks. Well, that's never going to happen. Number two is, let's move away from crisis alpha. Here's what happens when you add a 5 or 10% allocation to CTAs. The low expectation that managed futures has for its own self is so shocking. They've got all the systems, all the computers, all these smart people. They can trade all these different markets. Oh, but no stocks. No. And it has to be in a managed account. We're not going to give it to you in your fund because that's not what managed futures does. My idea of creating a new sector, the fifth sector, which is crypto. I think that's a good idea.
Jerry, that's the part that I didn't understand, because for me, so I've divided the sectors into four, like Forex, commodities, credit, and equities. So anything else has to be under those four. So that's why there is no fifth sector, but we all have these differences, don't we? So
where's crypto?
Under Forex, of course, because there's fiat currencies. So that's how I did it. So there's fiat currencies, and then there's digital currencies, and that's how I divided up the risk, basically. I mean, in my back tests, it's just, crypto is working like on some years and they are not working on others. I think I was looking for 2020, 2021, 2022. There's not many history, but I don't think that the allocation of risk should be as much as like credit or commodities. But then again, we do have all these sorts of differences among ourselves, isn't it? So I'm not quite sure whether there is a right answer, more than like more of a taste and how it does look in your back tests.
Right. Okay, that's two good points there. One is, I don't do much with sectors anyways, right? I just sort of name them, and then I trade each market in the same size. So now with stocks, I limit the number I'm going to trade, since there's thousands of them. But I trade all of the currencies, all of the interest rates, plus the ETF fixed income, about 20 markets there, and then all of the commodities and the currencies. Yeah, okay. So I trade all of those, and then I allocate the same risk units to each. So since there's only 24 markets in my crypto sector, then that's smaller than the 55 commodities, which is a bit smaller than, well, I probably have 30 or 40 dollar-based currencies and 50 cross rates. So is that two sectors or one sector? Yeah, so it doesn't really matter to me, the sector stuff, so much as it relates to the trades I'm putting on. I just, like, for maybe marketing reasons, say, oh, look at me, aren't I special? Now I have a crypto sector. But and as more markets come on in that sector, it'll get bigger. So all the markets are, so all the sectors are sort of weighted depending upon how many markets are in that sector. So yeah, obviously crypto is the smallest by half, which commodities was the smallest. Now crypto is the smallest at about half, less than half of the commodities. Now it's very interesting, though, the other part that you made me think about, which was, then you've got to do this analysis, though, to prove your point that crypto acts like other currencies. I mean, I think that gold and silver are kind of acting like currencies now. Yeah, I look at my commodities performance on a daily basis, and I'm looking at gold and silver, and I'm like, oh, okay, dollar's down. Oh, okay, dollar's up. And that usually works. Gold's up, dollar's down. So, okay, but I'm still putting gold in the commodity sector, but it doesn't have any impact, okay, on my gold trades or the size of my gold trades. Now, a lot of people might even say, so back to the ultimate question, have you done this analysis that shows that crypto, yes, that is a currency too. That acts like the yen and the pound. Well, I trade the yen and the pound and a lot of other currencies. They look very similar to me. I don't really know if crypto, by some sort of numbers analysis, should be considered a currency as well. And then I think a lot of people, I don't really know too much about this. I don't want to know too much about it. A lot of people will say, when you trade these currencies, all you're doing is trading other countries' interest rates. Oh, okay. So currencies and interest rates are kind of the same, very correlated, very correlated to each other because of the relative rate changes in the countries. So, but I'm going to call that two different sectors. Currencies and rates, two different sectors. I don't care if they're sort of correlated. So I'm building this case that you're contradicting yourself because you already are doing something you're telling me not to do, which is you got currencies, you got rates, but you're calling them two. I don't even know if you do the analysis that crypto looks a lot like currencies. I don't know. I haven't done it.
No, I haven't done that either. I think the way, I think my main philosophy is, when you study martial arts, okay, in Japan with a sword. So there's basically 4 basic moves, which all other moves come from. All right. So it's the basic martial arts thinking in a very traditional school. And now when I was thinking the way I'm trading, I thought that, all right, then there are only 4 asset classes, which is the credit, the commodities, the forex, and the equities. And anything else any other liquid asset must be part of those 4. So that's because of my background with yoga and the martial arts. I just thought that has fitted in. It wasn't actually tested on a back test, but the numbers are making sense on a back test when I incorporate the crypto from 2008. I think I've got Bitcoin from 2008 and the majority of others from 2020 onwards. But one of the other points is the how to trade crypto. Now, in my broker, unfortunately, I do have access to, around 10 crypto markets, but I can only short 2 of them, which is the Bitcoin and Ethereum. So there is that. And a lot of others are using crypto exchanges. So Jerry, how are you doing it? Are you accessing through, Binance or Cranking or something else like that?
Well, like I said earlier, of the 24, 2 are futures, Ethereum and Bitcoin futures. My wife asked me, like, I was telling her this yesterday on a long trip we took. We had to do a long road trip yesterday, and so that's why I had to cancel. But so I was telling her about it, and she's like, "Wait a second. What about Sam Bankman-Fried or whatever? We don't want to get caught in crypto." I'm like, "Oh no. It's futures. It's 2 of the markets are futures, and the SEC doesn't allow a cash crypto. They don't want. They're going to have to. They're being forced to to allow a cash crypto ETF to come into existence pretty soon. They better, or Bitcoin's going to crash. And but they've already approved many Bitcoin futures ETFs. So for the first time in history, futures are more secure, more safe than cash. And then the other 22 markets are stocks in the New York Stock Exchange and NASDAQ. So they're companies that are, according to ChatGPT and Bard and Google, they have material businesses in crypto and blockchain. And so I get in those, they have good liquidity. I get in and I take a small loss. So there is no coins or crypto accounts. It's just stocks and futures. I should have made that clearer.
Come on, Jerry. That's equity trading, for God's sake,
That's right. So, oh yeah, I've got more crap like that too, where I also also put preferred stocks and convertible stocks in the fixed income category as well. And junk bonds, they're in the fixed income. I also have more kind of contradictions. I have asked ChatGPT these questions, and ChatGPT has given me permission. A lot of these markets that I consider to be fixed income, but you could argue that they have some stock exposure, and they're going to go up on days when stocks go up as much as they may go up on days when bonds go up. The charts look much different than the S&P, and but I think this is the sort of stuff we need to exploit and just increase our diversification. And once again, I don't really care what sectors it's in. It's going to be treated the same way. Although, if there were 1,000 or 5,000 interest rate markets or commodities or currencies, then I would put a limit on that, like I have put it on a limit on the stocks. But my stocks are doing well, or I'm getting out of them. My shorts, I've got a lot of shorts on, they're doing well, or I get out of a bunch of them each day because they're reversing. But it's definitely possible to create a stock portfolio that does not look like the S&P, and that gives you tremendous amount of diversification and kind of force these stocks into your trend following process and structure and abuse them and torture them in a way that they're serving your purposes as a diversified trend follower. I mean, I'll tell you right now, the biggest issue that comes across my plate every now and then, I'll read it or people will talk to me, is that I don't care who you are. You could be the most diehard trend follower with the most managed futures CTA with the most amount of money under management out there, or in that SocGen 20. All the stock market is the S&P, and if you're trading stocks, you're just going to get the performance of the S&P. That's just a given. It's so far from the truth. It's very similar to saying, do you trade commodities in your portfolio? Yes. Gold and crude. Whoa. Gold and crude. That's all you've got is, what else would they have? Gold for sure. Probably oil would be an option in a buy and hold asset allocated portfolio. Then you would say, we would say, all of us would say, you're missing. Oh my gosh. In 21, I made all this money in bean oil, canola, and rapeseed. Where's your wheat? Where's your beans, your platinum, your palladium, your emissions contracts, sugar, and cocoa, and juice? Where are those? Well, I feel like I get commodities exposure by trading gold and crude. And this is no comment on what Andrew does. He does it for a different reason, the replication stuff. And then we would say, that's crazy. You're not getting the full commodities. You're missing some outliers. There's way more to this world. And I don't care if this commodity index you're looking at is heavily weighted to crude and gold. So what? You don't know what you're missing. And that's the exact same thing that managed futures, CTAs, and the traditional management says about stocks. I trade the S&P, and that's all there is to it. That's the stock. I get stocks, and I'll trade maybe some other indices as well. That's how I get it, and I'm not missing anything. And that's just so incorrect. You got to do some work, man. Don't be lazy.
Kerry, can I give you some system updates here?
You broke up, Josh.
Sorry, I have a system update here. I'm a retail trader. I'm long only, long-term equities. I leave the currencies, commodities, crypto, credit market, stocks, bonds, the commodity-based stocks to the professionals. I am a daily buyer of this new ETF, relatively new, called Trend TFPN, which I think stands for Turtles for Power Now. Anyway, I buy some of that every day, and that's fun. And most of my money's at Jerry's mutual fund. That said, I'm still having fun with my trend following experiment of the single stocks. I have CSI data scanning 6,000 each night for me. I'm looking at the 200-day close. I'm a single system guy. I look to buy things that are older than 1 year. I don't want any babies in my portfolio. I have 400 and as of this morning, I had 564 single stocks. But here's the kicker. 15% of them are red. 81% of them are green. And those greens are delivering, on average, 26% performance each. I've been in this portfolio since September 22. And over 80% of my portfolio is generating 26% average. This past week, I think I got into the triple digit returns. All of a sudden, I have $115 in, in my positive side. These are dollar fractionals. So I apply the same dollar to each via Robinhood. But on average, the whole portfolio of open equity is running 20% as of this morning. It's just the craziest thing. And a few weeks ago, instead of just stopping at 500,000 shares traded today, and of that, 500,000 average for the past year to consider the instruments, I dropped it down. I'm now introducing the 400,000s class. So I'm adding a little more. I'm stretching it out a bit. And that's been fun. And I'm now at 7 ATR on the stop loss. ATR is an average. I use 14 day. And now it's 7. It was 3, it was 4, it was 5, 6, 7. Now it's 7. Now I'm looking at 8. I'm not quite sure if I'm going to get to 8. But at some point, because I just hate being stopped out and then having to miss the run up and get back in high. It's just a pain. Okay, that's my update. Thanks, Gary.
I love what you do, Josh. It's great. I think you're approaching it the right way. I mean, I've advocated that and talked about it for a long time. And trading is fun. You should do it. It's like playing golf. You know, you want to watch golf on TV. You want to get serious about golf. Watch all the majors and have your fun. And then you want to go out and play. It's two different things. And then if you're golf professionals, you don't need to pay anybody to. If you want to be a professional trader, you don't have to pay anybody. Just do it yourself. It's fantastic. Yeah, it's great. It's so much fun. What we do is so much fun intellectually and monetarily, you know, just hanging on to these trends. My stepson was still long Eli Lilly. That's so good. So what a great trade. What a great trend. All right, DB, got 10 minutes left. What's up?
Hey Jerry, can
Someone asked me
I
a
ask you?
question on
So,
Twitter
so
I never answered. Oh yeah. Can you please share more about the breakout exit? As a Jerry fellow trend follower, exiting on a breakout doesn't make sense in my mind. Well, I think the Danchin channel turtle breakouts are you break out to new highs or new lows. So breakout doesn't insinuate a long trade or a buy. It can be a sell as well, just breaking out to new highs or lows. So if your system is the 50-day, getting out at the 50-day low on your longs, then you sell that breakout low, just like you would buy the breakout.
What's going on with these home builders?
I haven't watched them in a while.
Man, they are just, God, I can't get my head around, new housing prices are down 20%. Sales are down. Apparently, if you look at the revenues are down. And these things are just, I think Pulte ripped like something like 25% over the past, couple weeks, setting new all-time highs.
I know I haven't focused on them. My strategy is maybe a little bit smaller and components. Yeah, I see that XHB new highs. That's pretty good. I mean, there's so many things out there doing that. Shippers. Yeah, there's a long list of
But
companies out
it's
there.
like you look at the semiconductor companies, and like for me, it's just so hard to understand. Is there a fundamental reason? Like I don't know anything about chips, so I can't really say. But like home builders, it's a bit easier to look at data to kind of get a feel for, where are they, where are they going, and those home builders ripping kind of like semiconductors kind of tells me that it's not really, it's not a obviously not a fundamental move, and I know that that's not what you're interested in, but I was just noting that, man, some of these stocks are they're just absolutely ripping higher.
Oh, I would never make that claim that it's not fundamental. I mean, why would you make that claim? I mean, I don't know. I'm following these trends, and it could be fundamentals for sure. I mean, and I certainly wouldn't. I don't have no clue as how I would uh, compare that to chips. Chips are going great. Home builders going great. Home builders is not based on fundamentals. I don't know how in the world I could get to that, and I don't even want to, as you said. I don't even want to get
Well,
there
I'm
because
just
I'm just
saying housing
thought,
prices are down 20%. Like, it's a
yeah,
year
yeah,
over
but
year. It's like one of the biggest single year drops in home prices or new
sure,
home
sure,
prices.
but yeah, sure, but day one in investing 101, you're going to get up there and tell the client, the students, that the market is discounting the future. And so negative fundamentals today have nothing to do with what the market sees as positive fundamentals down the road. And they're going to say, really? Yeah. So uh, that's the first thing someone told you as well. So you're forgetting that first rule.
Yeah, that's true. And the healthcare shorts, look really good. Pfizer had a really big sell off, and I just wanted to mention some of the other people I know that are in the mutual fund space. Just equity, I guess value investing, long only equity, and even a lot of the people that do research are really starting to take a hard look at longs on healthcare for 2024. So I just wanted to throw that out there. But looks like all the healthcare shorts have really, really paid off. And that's not to say that they won't continue to pay off into next year. But I just wanted to mention that some players, not big players, but some players are, interested in that healthcare space. They think that they're getting a good deal, maybe on on some of these names that have been sold off quite substantially.
Oh yeah, that's something I face all the time with my shorts is, the shorter, the more money you start making in the shorts, you'd have these huge monster updates. People just cannot control themselves. I just want to get long at the low. It's almost like, who gives a shit about making money? I just want to be able to print that we bought this all-time low in some stock, and they're doing the same thing in the bonds. I mean, it could be right. Obviously, it could be right. I was short UNH, and so that's making new highs. And then some of the other ones, obviously that you were talking about, they're making new lows. Um, but I met this guy one time, and he wanted to invest. And I was like, sure, we'd like to have you as an investor. And he says, well, I have all my money in this one stock. I'm like, okay. And he said, it's United Health Group. I was like, okay. I think that's who we use, for our health insurance. I was like, okay, cool. So I happened to then I went and looked up this chart. And I mean to tell you, there's probably not a better performing stock in the history of stocks than United Health Group. And I was like, oh crap, man, are you sure? Because this is the stock. I mean, it is just amazing. I'm looking at it now, and it's just up and up and up, with the few
Well,
drops.
can you imagine, like, if this Ozempic stuff turns out to be like a safe drug? I mean, I would think that that's going to really help some of these insurance companies, because being overweight just causes, like, from a health standpoint, causes like multiple system failure, like heart, kidney, and other liver, so on and so forth. So I wonder if this Ozempic thing is going to end up being a good thing. That was kind of a side note. I don't want to get off track, but
Yeah, well,
yeah,
I think it's a good side note, but I could also make the case that it's going to be very bearish because people, I bet you these people, we're going to have a lot of healthy people who don't need insurance. I think they could be very afraid by that. I mean, I'm not really sure which way it's going to go. It's kind of like I bought this one insurance company. This is just a story, not advice. I'm not going to say which one it was, but I went long based upon the upside breakout. and a year or so ago during hurricane season, right? And you're thinking, oh, look at all these stupid hurricanes. This cannot be good, right? The stock has crushed it. These insurance companies are crushing it. You cannot buy insurance in Florida for hurricanes. They charge you crazy amounts. They don't pay off, and they're making a ton of money. So I am not so sure that what seemingly looks like good news for these insurance companies is good news or bad news, and vice versa. I'm never sure what they're going to do. And this is one of the ways, I don't know if you could do it in size or figure out how to do it, but if you're pissed with your cable bill, your insurance, your health insurance bill, and your home insurance bill, probably a pretty good idea to go long those stocks and at least offset some of your expenses, because that seems to work quite well. No advice, just kind of a joke, honestly.
Just two more things I wanted to say. I listen to some value guys. They run a value fund, and their motto is like totally opposite. They're dumpster diving. They don't like to buy the trend. They like to look for deals and so on and so forth. And it's just kind of interesting to listen to people with the different strategies. Personally, I do like trend. Like I like something that's showing you the direction that it's going. I think why can't you lay trend on top of like value? And I guess not everybody thinks that you can do that. I think that some of these guys could probably implement a bit more trend into their strategies, and they would probably be a lot happier for it because they'd probably have a lot less drawdowns. But I wanted to say more importantly, talking about Bob Elliott. A lot of these guys recently have been talking about Bob Elliott. I don't know what he's been saying on Twitter, but it's got like a lot of these like guys that run mutual funds. He's said something that's ruffled all their feathers, and I don't know if you know anything about it, or has he said anything controversial in relation to stocks or maybe in relation to bonds?
No, I haven't heard anything about them. And he's the guy that has a hedge fund replication, HFND, I think. And then he used to work, it's the same guy that used to work for Dalio, right?
Right. So I finished the last like quarter of that book, and like, oh my God, like it was crazy, like kind of how he treated Bob. And I mean, I just have a totally, I know nobody's perfect, everybody has their flaws, but like when I read Principles like 3 or 4 years ago, I was like, Ray Dalio Principles, and then I read this book, and now I'm kind of like, oh my Lord, this guy's he's a character. But apparently you were saying earlier about people that have systematic funds are not 100% systematic, and I think Ray Dalio is an example of that. I think the book said at least 10% of their trades were just pretty much just punts that he just took on a whim, that really didn't have anything to do with systematic or anything. They were just trades that Ray just wanted to put on. But I was just making the comment about Bob because it just seems like he's calling for, I think he's saying that a lot of people are saying that rates are going to go higher, and all these equity investors that are so fixated on, that's the high, or I mean, excuse me, rates are going to go lower. And all these equity investors that are fixated on that, they're like, okay, we think rates are going to go lower. He can't connect why they think rates are going to go lower and stocks are going to go higher. And I think that's made a lot of these equity investors mad, because that's not what they want to hear. They want to hear that stocks are only going to go up. But I think he's just making the point that it just doesn't make sense that, if you think rates are going to go lower, you should think stocks are probably going to go lower, not higher. And I think that's probably, made rub some people the wrong way.
Right. Okay. I'm going to go. Hey, let's go get ready for the big football day today, college football. Last night was fun, good upset. I love when the 9-point underdog, undefeated, having already beaten this team earlier in the season, is the 9-point underdog. and it wins. That's really fun. Love that. I love making fun of college football with its committee. Only sport in history of the world that has a committee that decides who gets into the playoffs versus objective rules of this is how you get into the playoffs, this is how you become a wild card team prior to the season. We all know how to do it. Not in college football. Condoleezza Rice and her committee is going to tell us who's going to play for the championship. It's insane. So I love when they're all wrong. And let's root for Alabama. You know, it could be a hard one for most of us, but to throw this whole thing into ultimate chaos. Hopefully, you're just a year or two away from 8 to 12 to whatever 20-team playoff. It's so much fun. All right, next Friday, 7 a.m. I'm almost 100% sure, as usual, we'll be here. Thanks for being here. Send me some direct messages if you have some comments, complaints, suggestions, questions. Thanks, Richard, for recording all of this. And thanks, everybody, for being here. See you next week.